Assalamualaikum and hi, we are from Group 1. Today we are going to present about a ratio analysis between YTL Corporations and Sime Darby Berhad. This is our members of our team. We have Muhammad Daniel Haikal bin Raji'i, Muhammad Amjad bin Muhammad Taib, Muhammad Arif Hambali bin Muhammad Zawawi and me Muhammad Adam bin Zafrul Nizam.
YTL Corporation background. Founded in 1955 by Tan Sri Yoh Tiong Lai, YTL Corporation began as a small construction firm in Kuala Lumpur. Today is a major Malaysian conglomerate with significant global presence, listed on the Bursa Malaysia Stock Exchange. YTL is known for its pioneering spirit, often being the first to enter the industry like power generation and telecommunication. Its unique strength is an integrated approach, managing everything from manufacturing building material to construction, property development and community services, creating lasting value across the globe. Sime Darby Berhad background. Established in 1910, Sime Darby Berhad has a rich history that began with managing rubber plantation in Malaya. From this humble origin, it has grown into a leading Malaysian multinational conglomerate proudly listed on Bursa Malaysia. While its roots are in plantation, Sime Darby has significantly diversified its portfolio over the decades. Today, it is a major global player with core businesses in industrial equipment, motor vehicle distribution, and healthcare, driving progress and prosperity for over century.
Liquidity ratio of Sime Darby and YTL Corporation. Sime Darby uphold an extremely low debt level, which is very low debt ratio, and a significant amount of equity financing, which is high equity ratio, highlighting a conscious and low-risk financial framework. Conversely, YTL Corporation function with a considerably elevated debt level, which is high debt ratio and debt equity ratio, and a small equity proportion, which is low equity ratio, signifying a more assertive, high-risk, high-leverage financial approach. Sime Darby capacity to meet interest payment, which is time interest earned, shows significant volatility, reaching a high in 2022 before decreasing, yet stayed sufficiently elevated for comfort in most years. YTL Corporation maintained a consistently lower yet stable and improving capacity to meet interest obligation, which is time interest earned over the period.
Activity ratio. Our analysis of Sime Darby and YTL Corporation reveal a clear divergence in operational efficiency, particularly in working capital management. The most striking difference is in credit control. Sime Darby excelled here with an average collection period improving dramatically from 49 days to 36 days. This indicates a highly effective system for collecting debt from customers quickly, which significantly strengthens its cash flow. In contrast, YTL Corporation collection period remained consistently high, hovering around 90 days. This suggests a more lenient credit policy, which can tie up capital and prevent cash flow challenges. Furthermore, we see different strategic approaches. Sime Darby maintained a stable, longer payment period with suppliers around 70 days, skillfully using trade credit to its advantage. Meanwhile, YTL managed its inventory at a similar rate but takes significantly longer to convert its sale into cash. In summary, the data paint Sime Darby as the more agile and efficient operator in managing its receivable and cash cycle. Our analysis of asset utilization revealed a fundamental difference in how efficiently Sime Darby and YTL Corporation use their investment to generate sales. The data shows Sime Darby is a standout performer. Its fixed asset turnover has shown strong and consistent improvement, rising from 3.33 times to a high of 4.72 times. This means Sime Darby is highly effective at using its property, plant, and equipment to drive revenue. Similar, its total asset turnover remains robust and stable, consistently around 0.8 to 0.95 times. It indicates a company-wide efficiency in leveraging all its assets. In stark contrast, YTL Corporation efficiency is significantly lower. Its fixed asset turnover, while improving, remain below 1 time, hovering around 0.8. This suggests a much heavier asset base, common in utilities and infrastructure, that generates sales at a slower rate. The conclusion is clear. Sime Darby demonstrates superior asset efficiency, effectively squeezing more revenue from its investment YTL model by its nature.
Now for the leverage ratios, as we can see from this table, we can see a slightly difference in percentages between the Sime Darby and YTL corporations. However, these differences shows a significant effect for both parties. Overall, YTL operates with high debt, but it's steadily improving its ability to manage it, while Sime Darby is far less indebted, but its ability to service its existing debt has recently and sharply weakened.
Now, let's move on to the profitability ratio comparison between Sime Darby and YTL Corporation from 2020 to 2024. First, looking at the gross profit margin, YTL consistently outperformed Sime Darby by a wide margin, which is in 2024, YTL recorded an impressive 29.96% compared to Sime Darby's 4.10%. This indicates that YTL has stronger pricing power and better cost control in its core operations. Next, for the next net profit margin, YTL showed the most dramatic turnaround while they recorded losses in 2020 and 2021. Their profitability surged significantly, reaching 9.90% in 2024. In contrast, Sime Darby remained relatively stable but lower at 4.90% in 2024. When we compare the operating profit margin, YTL again demonstrated efficiency gains, climbing to 23.7% in 2024. And also, this is substantially higher than Sime Darby's operating margin of just 4.10%. Finally, in terms of return on assets, Sime Darby was initially more efficient at generating profits from its assets. However, YTL's turnaround has been remarkable, reaching 2.51% in 2024, almost closing the gap with Sime Darby's 4.2%. In summary, while Sime Darby maintained a steady performance, YTL showed a major recovery and growth, particularly in gross, operating, and net margins. This demonstrates YTL's strong improvement in efficiency and profitability over the 5-year period. Return on equity, both companies ended 2024 with a very similar and strong ROE, which is Sime Darby recorded 14.21%, while YTL recorded 13.86%. This highlights that both were highly effective at generating their own returns for shareholders in the final year.
There are financial ratios categories, winners, and analysis. Profitability category, a remarkable and accelerating turnaround. In its 2024 gross 29.96%, net 7.02%, and operating 23.07%, margin far exceeds Sime Darby. Leverage category, Sime Darby is conservatively financed with very low debt ratio with low financial risk. YTL used aggressive leverage, which is riskier but was used to fuel its high growth. Activity categories, Darby is more efficient in collecting its receivables. However, YTL managed its inventory more effectively, meaning it sells stock faster. Last category was liquidity. It's unconclusive. It is because the provide data does not include standard liquidity ratios like the current ratio or quick ratio. A proper conclusion on short-term bill paying abilities cannot be drawn. Based on the comprehensive analysis, YTL Corporation presents a more compelling growth story and is the recommended choice for investment.